Markets have seen a cool-off after the UK's vote to leave the European Union. Hillary Clinton and Donald Trump are set to go head-to-head as presidential candidates in the US elections, and Europe has been shocked by tragedy. I'm joined by Mark Burgess from Columbia Threadneedle Investments to discuss this month's key investment themes. Hi Mark.
Hi Deborah.
It's very good to see you again.
You too.
So 1 month on from the UK shock vote to leave the European Union, and the equity markets have been relatively strong. Has the decision to leave led you to change your views on global economic growth and the likely impact on monetary policy?
Well, as you say, the leave vote wasn't expected. It wasn't the market central case, and we thought that if that were to be voted in, we would see a correction in equity markets. We saw that on the first day, but since then, equity markets pretty much everywhere have rallied pretty hard. What's not changed is our expectations of what it means for growth and monetary policy, and I think the reason that equity markets have rallied hard is because of the slowdown that we are going to see and because of the response that we're going to see from the central banks. The central banks stepped in very quickly and said that they will be providing abundant liquidity, that they would likely ease policy, and that would support markets. And we've seen bond yields fall very sharply as a result of that response, and that fall in bond yields has helped to underpin all risk assets, equities included. So I think we probably overlooked the fact that equity markets would rally as hard as they did against that backdrop. But certainly the economy, certainly in the UK, does feel like it's slowing down. We had a leading indicator last week that showed quite a sharp correction. We've seen some growth slowdowns a bit in Europe, so I don't think our views have changed, but the response from the equity markets wasn't what we expected.
What implications do these changes have for your view on markets?
Well, I think the simplistic kind of rising tide raises all boats view that falling bond yields support risk assets, I think holds true. It feels like a fairly fragile investment view to have because the fundamentals don't feel that great. Growth is slowing, as I said, in Europe and certainly in the UK. But with bond yields so low, supported by easy monetary policy in Europe and in Japan, that has to underpin yielding assets, whether it's equities or credit.
Now, moving on to the US, lots going on there as well. Hillary Clinton and Donald Trump have been nominated as US presidential candidates by the respective parties. Should either candidate become president, what impact could this have on markets?
Well, I think the US is the one place where there is some decent growth coming through, albeit at lower levels than you might have seen historically. As we know, the Federal Reserve is looking to normalise monetary policy and raise interest rates. To be fair, its ability to do that is somewhat hampered by the conditions we've been discussing in Europe and in Japan. And easy monetary policy in those regions kind of suppresses and depresses bond yields in North America and makes it less likely that they will raise interest rates. I think we're facing a very interesting situation with the two candidates that we've seen. I think were Mrs. Clinton to be elected, we would likely see a continuation of some of the policies that we have seen from Obama's last two periods in office. If Trump gets elected, I don't think we know enough about his economic policies to know what he might do, and I think that uncertainty could be quite a depressing feature for markets.
And could any specific sector, such as, for example, healthcare, be particularly affected by the victory of one particular candidate?
There's been a lot of focus on US healthcare. The US spends about 17% of GDP on healthcare provision. In the UK, we spend about 11%, and mortality rates are the same. So there's a lot of focus on where that money in the US is getting wasted. And the two candidates have quite opposing views as to how you might close that gap. So, for example, Mrs. Clinton has got a big focus on the cost of drugs. And would look to contain the rise in drug prices. Trump would look to repeal the Medicare program that the Obama administration introduced. And I think were either one of those, to be elected, then we'd have quite different outcomes on the drug sector, and that would be a big focus.
And finally, are there any trends you're seeing which could be important to markets in the long and short term?
One of the big features that we've seen in the UK market has been the outperformance of large cap, and with sterling's weakness, which had been expected on a leave vote, then we've seen a big re-rating of the large cap stocks, because they've had an upward revision to their profit forecast because they largely are international earners. I think that's a feature that's likely to continue, not least of all because large cap has materially underperformed small and mid cap over the last 3 or 4 years. So that's kind of reversed, and I think that's a trend that we'll see continuing certainly for the balance of this year as those profit forecasts work their way through numbers.
Well, thank you very much for your time, Mark, and we'll be back again next month.